Hi, this is Pete Birchlow, StockMarketAlchemy.com. It's October 31st, Thursday evening. U.S. markets are closed. This is going to be a relatively brief update on the bond market here in the U.S. The chart we're looking at here is symbol TLT. So this is the iShares long-term U.S. Treasury bond fund. And what I wanted to point out here is a relatively measured correction that is currently happening in the bond market. So what we've seen over the last year or so is a major top in the bond market this past July. So if we move out to a weekly chart, we can see back this past July. Since then, we've seen a relatively substantial correction, around 30%. A little bit less than that in the bond market. We have a potential head and shoulders pattern with a broken neckline that suggests the market moving down into this 98 region as a minimum measured move based off of the typical textbook target. Now, moving back into the daily chart here, what I want to point out is that the corrections we've seen so far off of this high, we saw this, approximately 2-month correction that went from about 118 to 127, and then we saw this approximate 1.5-month correction that went from 115 up to about 124. So both roughly $9 moves or so. And off of the August low here in bonds, we have seen roughly 2.5-month rally or so here, and we can see that this rally has peaked. It's actually a weaker rally as far as rate of gains than the other rallies. So they ended at these points here, and so we've already surpassed that time, and we've not even risen to those lines. So it doesn't necessarily look good for any type of lasting bottom in bonds right here. We have a mature correction at 2 months here, upward correction in this case. It's smaller than these other corrections here. And if we look at the momentum indicator below here, we can see it's back up in this region, roughly where these past 2 corrections peaked out. So based off of that here, we might see a little more movement up here, but even if price rises another few percent, it would still be right in line with the price size of these corrections here. So I think if we see any type of breakdown, maybe we use a trend line, kind of a base trend line here off of this correction, and if we see this trend line broken, that could very well be a signal that either the upward correction here is done and we're going to resume a bearish type of move, or possibly we see a false break and then another attempted breakout of the high. So those are a couple scenarios I would be looking for. We don't really have any type of divergence pattern developing on the daily chart yet, so we could certainly see a little more weakening, another move to higher highs for this rally here that creates a better divergence pattern. But I think at this point, if you're looking to trade the bond market in particular, if you're wanting to look at short positions in the bond market, we're probably entering the time frame to do that. You need to have your indicator set up that you're watching closely, and then obviously excuse me, we need to be having objective type of signals that we're making our trading decisions based off of. So it's one thing to make a forecast and understand that we have this type of measured correction or measured movement compared to these past corrections, but we would need to see some type of initial confirmation for the move down if we want to use a tight stop loss. If you're allowing the market a very loose stop loss, let's say the correction here has moved from 102 to 109, so $7. If you want to put your stop another $7 or $8 up here, somewhere around 114 or 115, you could certainly look to short into strength here at these levels, and then you would need to size your position accordingly. So there are different ways you can choose to play this. I guess the question is really what's going to get you the best entry, the biggest position size, and the biggest reward to risk ratio based off of the move. If we back out to that weekly chart, let's say we were able to short, let's say we have a minimum move down to 98, that's another roughly $10 down from here. So if you can get in with a $2 risk on a $10 move, that's a really nice trade, and certainly based off of chart support, we don't have any support on TLT down into this 88 level here. So we could see, excuse me, prices fall substantially more over the coming weeks. So that is my take of what to follow on the bond market. If there are any more questions on this specific market, any other indicators you'd like to look at, drop me a comment on the video here or on the blog over at stockmarketalchemy.blogspot.com. That's all for tonight. Have a great day and all the best to your trading.